Good afternoon, everybody. My name is Vic Kruger. I'm the partner, one of the partners in our corporate recovery practice here in Calgary. And today, David Yeager is going to talk about the state of the Canadian oilfield services industry and projections and forecasts of 2018. David, for those of you that don't know him, been in the oilfield services industry for over 35 years as actual owner of oilfield services companies. He's built up 3 or 4 public companies, amalgamated in other companies into the public company. And we're very happy to have him here at MMP helping us. David has also been a reader of various articles related to the oilfield services. He's a former owner of Rough Tech magazine. He's been involved in industry, various industry associations as well. The way David approaches this is we'll start off by doing history of what's happened to how we got here in the oil field, or mostly in the energy services or energy industry. Some of you may have already heard this before, but probably good refresher. And then he'll go into the current state and what's going to happen. Future or people. This time, I'll hand it over to David. Oh, I should also mention that we will have a question and answer at the end. So please hold the questions. David?
Thanks, Vic, and good afternoon, everyone. I wish I had some good news, but it really depends sectorally. It's not as bad as it looks, although it does look good. So I'm going to go through a bunch of information, try to add a little color to the data you're receiving. Basically, there's really 5 things to talk about, or 6. What is the oil service business? How did we get here? I think that the historical is easier to figure out where you're going. Where is the current situation occur? Where are we going is the cumulative outlook. How you should or could stick handle through the market. So what is an oil service company? Well, what we did when I was the chairman of the Petroleum Services Association, we did a major study on the size of the business. To define it, so we define the oil service industry as everything an oil company does. As you can see on the left, and service company. At M&P, we divided it into 12 major buckets of businesses, and they all perform somewhat differently, and I'm going to go to that in the circle that starts and the full cycle of dollar. So sources of revenue for oilfield services, I think it's 2 components of this. Where the producers or E&P exploration production companies get their money. The number 1 source is cash flow from existing oil production, and we've got some slides coming up on that. Number 1 source of revenue or reinvestment to drive the service business. And then there's E&P capital inflows, additional money beyond production for exploration and production companies. This could be equity, this could be debt, this could be intercompany or transfer. We'll caution people in the service business that you ought to pay some attention where this comes from. Most people in the service business don't care where the money comes from as long as the check doesn't bounce. And we're suggesting that oilfield service managers have a better understanding of this. Where do oilfield service or OFS companies get their money? First is Capex, capital expenditures by our clients, the E&P companies. E&P operating costs, I've got a slide on that coming up. And then service sector Capex. this is money spent by oil field companies, pipeline construction, and so on, and that is the source of revenue.
This is revenue and cash flow. This is possibly the most important slide in the program. This is the value of all the oil and gas produced on a yearly basis in blue, as well as the free cash from production available for reinvestment, which is what I talked about earlier, in red. And so you can see in 1998 to 2008, in 1998 the revenue was $26.5 billion, rising to $145 billion, straight up. Just a market in which, for oilfield service companies, it was just a great market for growth. There was a correction in 2009, as everyone knows, but what followed after 2009 was 5 consecutive years of growth, resulting in the highest revenues ever in 2014 of $148 billion estimated. The 2015, of course, is a massive correction because of the oil price collapse, but the disturbing number, or the number that we should watch, and people are always wondering, how do I gauge the performance of the business, is free cash flow from production, and that is free cash after operating costs, lifting costs, etc., available for Capex. So 2015, ARC Financial estimates $22 billion, which is the lowest number this century. These figures are not corrected for inflation. So when oil service guys say, well, gee, the customers want lower prices, we'll just understand why. The fact is there's a distinct shortage of free cash. The capital expenditures, this slide is meant to show two things. Is one, the size of the service business and how it grew. You can see the blue line is conventional Capex. That would include shale drilling and tight oil, shale gas, and the 10-year average was $35 billion. But again, the elephant in the room was the oil sands, where Capex grew from $2 billion 15 years ago to over $30 billion last year. And this resulted in what I call the development of a parallel oil service industry, both oil sands and conventional. And this is what really got the rivets popping on the labor market. The fact is the capital expenditures and the labor demands vastly exceeded the capacity of the Western Canadian Sedimentary Basin. And so as a result, wages went through the roof, and we ended up with a cost structure that may not be survivable. There's been a massive correction this year, and there will be more figures on this later. Just as the gas boom, it's good to understand the production mix, and I'll be talking about that again later. But from the period of 2005 to 2008, the price of natural gas went through the roof. 2005, because of Hurricane Katrina, the value of all the natural gas in Canada rose to $52 billion. By 2012, it had fallen to $12 billion, a $40 billion correction in revenue. This has resulted in a serious realignment of the service industry over the past few years as drilling and service companies that were tooled up for natural gas development had to retool for tight oil and oil sands. Of course, there was a massive capital investment that followed. But again, you'll understand more how significant this was in a couple of slides. The oil sands boom, there it is. Everybody's seen it. You've seen the ads on television about the bus company in Montreal that's selling to the oil sands, and the claims that this drives the entire Canadian economy. If you look at the revenue, it's absolutely staggering. $4 billion to $64 billion over 15 years. Again, this is a mono-directional growth curve that's been kind to everyone who participated. Operating costs are part of the service business I've always liked, is keeping existing production producing. Again, this has increased by a factor of over 500% over 15 years. In 2011 was the first year when oil sands operating costs surpassed conventional, and something we can expect to continue. What I've done later in the program is that this put a third of these revenues into the pie for oilfield services. That's just an estimate. There's no granularity on these figures. This includes natural gas for making steam or separating oil sands, bitumen from oil sands in the oil sands, and it also includes operating plants and so on. There's no granularity, but a good chunk of this falls into oilfield services. This is the figure that we caution all oilfield service managers to keep an eye on, which is the reinvestment ratio. It's a simple ratio of Capex over cash flow. And so in 1998, we reinvested 150% of cash flow. Well, that was an accident because the price went down. You see that royalty trust area? Well, that's congruent with the natural gas bubble or boom that we demonstrated earlier. Natural gas over $10 was a fabulous business. You could sell it for 10, produce it for 1. And so the industry ended up in a situation where they could refund money to shareholders, the so-called royalty trust, the beginning of the dividend model. They could drill 20,000 wells and couldn't really figure out how to spend the money. In 2008, the reinvestment ratio plummeted to only 65%. Oil went to $145. Gas went to $10. Couldn't figure out what to do with the money. But most importantly, is since 2010, there's been significant cash inflows available to E&P companies, which include oilfield services. And this has been from equity raises, debt, and transfers, intercompany transfers from the downstream operation to upstream, and transfers from external countries to this country. For example, Statoil taking money from elsewhere. This year, the reinvestment ratio is expected to be 170%. This is a straight ratio of Capex over cash flow. What we ought to do is understand where this money is coming from. Again, in the oil service business, we don't much care where the money comes from as long as the check doesn't bounce, but we ought to be paying attention to this, because when this dries up, of course, this is going to materially affect oilfield service activity. So now we're into what happened. Well, this is the global, on a quarterly basis, going back a year, global supply and demand. These figures are from the International Energy Agency out of Paris. They're updated as of last Friday. But in Q3 2014, up till September 30th last year, supply was 94 million barrels a day. Demand was 93. The surplus was under 1 million barrels a day. And WTI averaged 97 U.S. In Q4, the surplus started to grow as supply grew faster than demand. The surplus was almost 1.4 million. On November 25th, 2014 was when OPEC, particularly Saudi Arabia, declared they were no longer going to support the price through production controls. The downward spiral began. Q1 last year, not only did the surplus grow, but there was no price support, so the price tanked. In Q2 last year, of this year, April, May, June, we got the classic dead cat bounce, where oil hit $60 again. But you can see the demand over supply was short by 2.57 million barrels a day. When these figures came out in the end of July, that resulted in the August retraction of the price down to $38 a barrel. Q3 improved somewhat, July, August, September. The surplus shrank to $1.61, but of course the oil was trading on the previous quarter's figures. And again, the average price to September 30th from July 1st was only 46. So there's been all kinds of talk about conspiracy theories and somebody out to get somebody, Saudi Arabia out to get the shale producers and somebody out to get Russia, etc. In the end, it was really supply and demand with no supply management. The surplus was the figure that was in the paper Friday. And one of the things we really ought to be careful of as oil watchers is the media coverage is really poor. So we all read or heard or were told that there are 3 billion barrels of storage, and what are we going to do now? Well, here's the 5-year average, which is 2.75. So while I'm not disputing that there were 3 billion barrels in storage, but instead of the media reporting, and Bloomberg did this, Bloomberg did not say that this is only 10% above the 5-year average. There are 2.75 billion barrels a day in storage on any given day and always have been. This is because pipelines hold oil and production terminals and tanks on site and tankers en route. So there's been an enormous amount of alarmist media coverage. This is yet another example. It's not good that there's 300 million barrels a day of extra capacity. But again, it was on the news this morning that there's a 31-day supply. It's actually a 3-day supply of the surplus. The distillate stock is concerning, however. This is refined product, and that is up by something like 30 million barrels a day per quarter. And this is inventories of diesel fuel and natural gas. So I'm not saying there's not a problem with storage, but it is a bit overblown by the press. Here's the United States as of the first week of this month, And again, there's the 5-year average is something in the range of 1.1 billion, and the current is about 1.3. So there's a couple of $100 million. Again, if you look at the figures without putting them into context, yes, this is 20% above the 5-year average, but it is not 100% over zero. This is the numbers that really matter, and this is a 5-year look at global demand and supply. And the blue bar is the surplus or deficit going back. The green line is supply, and the yellow line is demand. So you can see that the first little green star in sort of Q310 is when in the third quarter of 2010 there was about a 2 million barrel a day shortfall. And in the first quarter following that, once that information came out, WTIs went for $100 and stayed there. And then the other green star is Q2 of this year, when there was a showed you that number, 2.5 million barrel a day surplus, and then oil headed for $38 a barrel in the next quarter. So again, we can talk about all these theories and so on, but in the end, it's simply a supply and demand factor. What you see in the blue part is you see, all things being equal, these curves crossing in the second half of last year. What the International Energy Association is saying with the purple part, or the brown part, is they're just not sure. This is a factor for extra inventory, Iran, and refinery runs, or distillate. But there's no question the surplus is meant to disappear next year. Demand is continuing to rise. Production is following. So the light at the end of the tunnel is not a train for oil. A long tunnel. Hope you've got enough of energy, but in the end, this too shall pass. This slide looks complex, but it's not really. And there's been a talk about the end of the commodity supercycle. So this is WTI in black versus 7 other commodities. Most of them, with the exception of potash, are actually oil and gas inputs. And what it is the year or the month in which they peaked, and then their current price as a percentage of their peak price. And so everybody said oil was lower for longer. Actually, it was higher for longer, when you can see that during this period, oil hung in until the OPEC meeting a year ago. But without supply management from OPEC, or Saudi Arabia in particular, we're just another commodity. And the sobering fact about coal, iron ore, copper, potash, nickel, rubber, and aluminum is nobody's run out of any of them, is that there's been no shortage of either. And so this is what they call the end of the commodity supercycle, is oil caught in an overall commodity downdraft caused by oversupply and the rising value of the U.S. dollar? Absolutely. So here's another twist in what is affecting crude prices. Just a few facts not included in these charts is U.S. light tight oil, or shale oil production, is falling. It's down 600,000 barrels a day. It's estimated to be down by 1 million barrels a day on a year-over-year basis. And so there is production coming off fairly quickly. That's just the United States. The U.S. shale numbers in the IA figures are wrong. We've laid down 1,000 rigs in the United States. There was a lot of baloney written about how the U.S. shale drillers were impervious to price, and that you just cannot lay down 1,000 and 1,600 rigs and sustain production. Capital projects globally are down by $200 billion. Iran, everybody's worried about Iran bringing extra oil into the market. I don't know this for sure, but I suspect the odd barrel might be sneaking over the border, overland, maybe not completely cooperating with international sanctions. And then there's no risk premium built into the oil price in a long time, despite what's going on in Iraq, Syria, and Yemen. There always has been I guess with inventories being 300 million barrels a day higher than the 5-year average, the International Energy Agency said, well, with this level of stocks, even if there is a supply disruption somewhere in the Middle East, there's a cushion, and I agree with that. But still, it is not an ordinary commodity compared to the other 7 when you look at where the commodity comes from, in much of it, and how things operate over there. The forecasts are, this is just earlier this month, the Petroleum Services Association, they're estimating that 5,150 wells to be drilled next year, a 3.6% decline. Meters drilled will actually increase, which is good. The rig operating days, pretty well flat. Rig operating days are oil service rental opportunity days, which are declining somewhat. They're going to spend less days on each well, and this is the advancement of technology and penetration rates, and the average well is going to get longer yet as they get better at drilling these things. And so that is the PSAC view of the world. National Bank is, the way they presented it was quite interesting. They have two forecasts. One was the 2016 strip, and this is if you looked at the futures price of WTI out a year. And so what would happen is, so if the futures market was correct today and the average price of 2015 was what you saw if you were to look on the CME or the futures index, then they would see a significant decline in capital expenditures next year. 2016 is a significant decline in drilling. However, National Bank Financial, if you buy into the thesis that sometime next year that these supplies are going to cross, or these curves are going to cross, production is going to decline because of lack of investment, demand is going to continue to grow because of low prices. They're seeing a $65 WTI increase and a bump in drilling. So again, it's a long ways out. If you say what you know today, it looks bad. If you look at what those curves crossing means, it looks positive. Canadian Association of Petroleum Producers, or Big Oil. The oil sands, they think next year are going to stay. Again, major projects are continuing to be built, things like Suncor, Fort Hills, and so on. Those will continue, so they don't see that big a decline in the oil sands. From what they knew at the beginning of the month, they're seeing a big downturn in conventional. So the next box, which is Capex by year, their estimate based on what they knew at the beginning of the month was that Capex this year was going to be $42 billion, which is barely over half of what it was in 2014, and the number of wells will decline again. So this is fairly pessimistic. The trends by sector, the 12 buckets that we look at in MNP, they're all down except manufacturing and fabrication. There's been still a bunch of money being spent on production facilities. This would include the Northwest Upgrader, natural gas plants under construction in the Montney and the Duvernay, pipelines being built, and so on. So that is directionally downward, but not bad. And then if you're supplying production services, which is keeping existing production on stream, it's directionally neutral with yellow, the yellow flag, caution being you'll have pressure on prices. So looking at these sectors, production services, again, the yellow one we just looked at generally, if most of the production is still economic in the sense the price is higher than your cash operating costs, so wells are being kept on stream. The plumbing business, facilities and pipelines is expanding with production. Shale oil drilling is 100% dependent on price. When we got that bump in Q2, the rigs went back to work. When we got $38 in oil in August, the rigs laid back down. So the second there's any hint of a price recovery, it's on a well-by-well basis. It will go back. I think one thing people should remember is sustaining capital expenditures in the oil sands are quite significant. This is a high-maintenance business. So the figure I've seen is that to keep the capital required every year to keep existing production producing is something in the range of $13 billion, which is almost half of total Capex. The big hole in the recovery for the near term is oil greenfields Capex, new growth Capex, new oil sands projects. There not only are there none in the books, but Shell walked on Carmen Creek partially constructed. So this is of all the elements in a major correction for the oilfield services industry, new oil sands projects would probably be the most meaningful. Just a bit about the oil sands. Here's the production from growth for the next 5 years. 756,000 barrels a day by the end of 18. That's more than all but three OPEC countries do not produce that much oil. That Shell Carmen Creek has dropped off, but that's only 80,000 barrels a day out of 756,000. So, I mean, this is not contributing this will contribute, I should say, to the world oil production, keep the price down. But if you happen to be in this business, it's very positive. The number of producing wells continues to grow. There was, at the end of last year, we exited with 240,000 producing wells in the Western Canadian Sedimentary Basin. If your business is keeping producing wells going, oil or natural gas, this business continues to grow. The drilling compared to just the rig count, like everybody says, it's tough in Canada, and I'm not saying it's not. The rig count as of Friday was down 57% from last year and 59% from 2013. But in the States, which is thought to be a lower cost operating area with more opportunity, in fact, the rig count for rigs drilling for oil is down 64% from its peak a year ago. And in the Bakken, North Dakota, which it's really tough sledding in the Bakken. You can see it's down almost two-thirds from previous levels. So it's a tough time in the industry when success is measured as we're not doing as poorly as others, but the Canadian rig count is hanging in quite well. And this is really a factor of geology. Just what we look at MNP to understand how the service industry is going is gross margin. I'm just in the process of updating this for this week's newsletter. But gross margin is really how you measure pricing, direct expenses like fuel and labor and expendables, and the efficiency of your operation. So at the end of the first 6 months of the year, what's interesting on the companies that gained gross margin on a year-over-year basis in the first 6 months were drilling contractors because they have a collapsible workforce. The companies that were sort of neutral year-over-year were a bit more diversified, but the vast majority of companies suffered margin leakage on a year-over-year, meaning that they were unable to cut their costs as quickly as prices fell. The alarming ones are the ones that I've highlighted, where I've got three of them are pressure pumpers, where every dollar of revenue for Canyon, Calfrac, and Trican cost them more than $1. And then the PHX, primarily a directional driller, what they did after these numbers came out was they laid off, I think it was 500 people. So this is where you look to get a good indicator of how they're doing in the field. What is the field pricing versus my direct cost? And again, we'll update this shortly in the newsletter. So funds available to Oilfield Services. I forgot to change the year on this. That first one is 2014. Every time I look at this slide, I remind myself to fix it, and then I forget. But in fact, 2014 is what it says 2015, with $104 billion. That's probably the high watermark for some time. This year is estimated to be $68 billion, 35% decline, and then next year, using cap figures, is $60 billion, 12%. So you can see there's something like $35 to $40 billion a year missing in action for the oilfield service industry, and this is going to require it. It's simply overbuilt. Again, as I said earlier, it's heavily oriented towards greenfield oil sands projects. There's no question the sector is overbuilt. Good things. LNG, Petronas, for example, has green-lighted their project, providing they get environmental approval from the federal government. Obviously, having a federal election in the middle of that does put an element of uncertainty. We don't know what they're going to do. The export pipelines, well, one died a couple weeks ago with Keystone XL being terminated as long as Obama's in the White House. The other three pipelines, Northern Gateway got a bit of a setback last week where the Liberals reaffirmed that they are going to ban tanker traffic on the northern BC coast, so that doesn't look promising. However, the two repurposed pipelines, one's an expansion, which is Kinder Morgan to Burnaby, and the other is switching gas to oil in Energy East, are still there. They're more in Canada. They're not new builds or greenfield builds, and so hopefully we'll get some pipe out of here. The oil price recovery, there is going to be a recovery in oil prices. It's not a question of if, just a question of when. And then if you are in the business of supporting the oil sands, production's growing. So what should managers do? Well, waiting for the recovery is no longer an option. You got to know your costs. Obviously, your lenders are incredibly important. If you have some revenue coming in the door, you could probably make a go, and it might be time to think about preserving your equity in some form instead of trying to ride it out. And I'll just go into these in detail. Holding to tight recovery won't work. One thing that came out of the PSAC forecast is that the short term, meaning the rest of this year and the first half of last year, next year, sorry, with thanks, Vic, the chances of the price supporting activity are pretty slim. So you've got to figure out how to live for 7.5 months. There is capital on the sidelines, and people will make decisions once they've hit bottom. I declare the bottom again today, but I've done that every day for the last month. Prices are sliding again, but I think Suncor's indication that it was prepared to buy Canadian oil sands is an indication that if we're not at the bottom, we're near it. And it would be nice not to have to sell anything in this market, meaning assets or part of your company or all your company. It would be nice not to have to price equity. You've got to know your cost. It's the market has been so kind. That's why I put that slide in at the very beginning about the rate of growth. You know, the rising tide raises all boats. You got to know your costs, and that might require a level of financial detail and attention that you haven't had to pay. I think that I've heard said that people are operating below cost. Moving and not making a margin on the job is not a good strategy. Every time you leave the shop or every time you sell something, you're taking operational risk on the health and safety file. You're taking reputational risk on the work. So I know when we were running our company in 2009, I said we need profit, not practice. And it's not. And so if you know your exact cost, you would not bother with the ones that you cannot at least break even or have a slight positive cash flow, because you're simply depleting your capital reserves within a market. You'll be unable to replace it. Your banker is your friend. They're large capital providers to the sector. They don't want your company. They really want to know what your plan is. So if you need a plan. If you're offside on your covenants, many people are. In the end, if you come in with a strategy on how you're going to get through the slump and be in a position to pay your loan back, they'll want to work with you. You don't have the information, call us, call somebody. But it's absolutely essential that you understand the position you're secured or subordinated lenders in and make the appropriate steps. Make your business, if you've got revenue and a cash profit right now, I mean, if you can go out in the field or sell something and have a positive margin on every sale or job, you got a chance. You simply have to tool your operation. When I say be merciless in cutting costs, I say this in every presentation. In 2009, our company was HSE integrated. I had to fire a third of the staff, had to let them go, 900 to 600. I had blood on my hands and ice in my veins, but we all took a pay cut. We got serious about it, and we called it a jobs preservation strategy. We defaulted on all our lending covenants, but we had a strategy for the bank. And so when I say be merciless, don't kid yourself. This all ties in. Watch your collections. I don't know if there's anybody out there trying to drill wells on Oilfield Services credit, but there has been before. And then in the end, maybe look at, with the massive contraction that's facing the oilfield services industry, am I going to make it? I think we're working in an industry that's going to want fewer larger suppliers than in the robust market we're in. And so if you can't agree on a valuation, if somebody wants to buy your company, if there's anybody that you can make a deal with, is one of your competitors. I mean, you're in the same business, you're in the same boat, you own the same assets. If there's two people or more people that ought to be able to agree on valuation, it's one of your direct competitors. This is what the clients want. They want fewer, larger vendors. This might be a strategy. There's just too many CEOs per dollar. Back in the 80s, which really was a nuclear winter, Ensign and Precision consolidated the drilling sector, and it wasn't that they got in a position to raise prices. They consolidated operations, they cut costs, they got G&A spread over a larger revenue base, and came out as two formidable global drilling contractors. Might have been nice to own a piece of those companies. And then if you want to bring in an equity investor who can help, this may be an option, but you're going to need some tight financials to be able to do it. So this is what I call the special good news section, that little red up. You know, I've been saying this for months, but I've been wrong. I predicted a recovery in oil prices, but it's got to get better because it can't get worse. That's not particularly scientific, but we've got to be close to the bottom. One thing I will say in over 3 decades of studying this industry is the herd is always wrong. What we tend to do in this business is we tend to take whatever happened yesterday and extrapolate it out forever, and it just never seems to be that way. When things are good, they'll always be good. When things are bad, they'll always be awful. It's just not going to work. This thing's going to turn. I can't tell you when, I can't tell you why, but we are selling oil at 2/3 of replacement cost or less, and even though the price on the market doesn't indicate this every day, a lot of smart people know this isn't going to happen forever. Again, your lenders don't want your assets. If you come up, they'd like to help you, and we'd like to help you come up with a strategy to get through this. And Canada is the 5th largest hydrocarbon producing jurisdiction in the world. We're not going anywhere. Before I turn this back to Vic, just a bit of a plug for M&P. We're right across the Western Canadian Sedimentary Basin. We've got shops in every town. We look like a bit of an oil field supply store. But I will say in the 25 years that I ran public companies, we used a number of auditors. They never had any idea what we did for a living. M&P is determined to be experts in oilfield services, and I congratulate them for that, and I'm just part of the solution. I'm going to turn this back to Vic.
Thank you, David. Before we get to the questions, just a little bit of the advertisement on M&P. We are the 5th largest accounting, business advisory, and tax firm in the country. As David said, we're everywhere where the oilfield services companies are in Western Canada. We've got over 5,500 oilfield services clients and 150 professionals that are basically all they do is oilfield services work for the various clients. We're the only firm that has a David, someone that actually gets his fingernails dirty in the business. And we've got our corporate restructuring specialists in all the major centers as well. And this being Alberta, for a lot of us, we've done a lot of, in the oilfield services business, we've done a lot of, or in the corporate recovery services, we've done a lot of oilfield services clients. We're a member of Praxity Worldwide, so we have representation anywhere in the world, and we have that relationship with them that we can lean on them for help. Here's our contact information. One of the things that David produces, for those of you that don't get it, is an oilfield services newsletter that he prepares weekly. I'm able to distribute that to you. If you're not on the list, please send me an email asking to be put on the list. That's for CASL purposes, the anti-spam legislation, and then we'll get you on the weekly list so that you can keep up with David's writings. So at this time, I would open it up for any questions that you may have. I'll also mention that, well, first of all, I'll apologize for the technical difficulty we had, but we are going to have this presentation on our website at mmpdebt.ca in case you want to revisit it or pass it along to someone else that didn't or was unable to listen to it this time. So, any questions?
Yeah, I've got one question here on the inventories. There's no question that the inventories are disturbing, as I said, partway through the program. The message from the markets where there's a 3 billion barrel oil inventory. Again, the real number is 300 million, and that is an overhang, and that's why when I showed you those IEA figures that they had that red line in there, what does Iran coming onto the market mean? And of course, 300 million barrels is a lot of oil on the surplus. I mean, it would be 1 million barrels a day for a year to work through this. But again, when you see that number, I just caution you that the real surplus is not $3 billion. It's the 5-year average is $2.7 billion, and a lot of the coverage about the oil industry has been simply reprocessing alarmist material. And for example, in the spring, when stock started building Cushing, you really got the impression that oil was going to be spilling over the tank tops and onto the ground, and resulting in a giant environmental hazard. When in fact, oil storage, when you see these numbers, the total oil storage in the world, I don't have that slide in the presentation, is 5 billion barrels, and that includes the difference between the 4.5 billion and the figures you see is strategic petroleum reserves in the United States, and they're filling them in China. So no, there's no question this is not good news. But in studying oil prices since the collapse last year and read everything I can find, we cannot overstate the degree to which market sentiment drives oil prices. And right now, since OPEC abandoned or Saudi Arabia abandoned its price management role on November 25th, the bears or the shorts have had a field day, and they're having another field day with this alarmist information. But I'm just not sure in the end, in a world of the demand figures on oil, and this is another thing you should look at. If you look at that chart that's on the presentation, demand has risen by a staggering 12 million barrels a day between 2009 and 2016, and there's no end in sight. So any idea that that oil is being replaced by wind and solar, etc., is just not true. So in the end, and then we'll see what happens in December the 4th. That's the next OPEC meeting. Tremendous pressure within OPEC to say, okay, Saudi Arabia, you made your point. The rigs are laid down. So I had the opportunity to meet the Secretary General of OPEC, Dr. Subroto from Indonesia, about 20 years ago or 25 years ago. And I asked him about what else do you talk about, the Secretary General of OPEC, about oil prices.